1980. When Pac-Man was king, a gallon of gas cost $1.19, and a share of Berkshire Hathaway was yours for a mere $290. A $1,000 check back then could buy you a Ford Pinto with questionable safety features, or a piece of Warren Buffett's financial empire. If someone had scraped together a measly $1,000, less than a month's rent, and handed it to the Oracle of Omaha back then, well, they'd probably be watching this video from their private island instead of their parents' basement. Let's paint a picture of Berkshire Hathaway, circa 1980. This wasn't some sexy tech startup promising flying cars. It was a struggling textile company with all the market appeal of a flip phone at an Apple convention, while Wall Street hotshots were busy doing whatever people did in the 80s, probably something involving cocaine and neon. Buffett was quietly transforming this textile dinosaur into an investment juggernaut. He wasn't buying companies making robot butlers. He was methodically acquiring businesses that sold things people actually needed. Insurance, candy, furniture. Boring was beautiful, and Buffett knew it. So, what unspeakable magic would have happened if you'd forked over $1,000 to Berkshire in 1980, instead of blowing it on a Sony Walkman and enough hairspray to violate the Montreal Protocol? At $290 per share, your $1,000 investment would have bought you about 3.45 shares. No crypto, no NFTs, no meme stocks, just plain old paper certificates in a company that made curtains. That's it. That's the revolutionary investment strategy. Bet you're disappointed it doesn't involve diamond hands emojis. Fast forward to April 2025, and each Berkshire share is worth an eye-watering $620,000. Let that sink in. Time for the dramatic calculator moment. 3.45 shares multiplied by $620,000 per share equals, dramatic pause with sound effect, $2,139,000? That's right, over $2 million from 1,000. That's a 213,800% return, which is approximately 213,799% better than your savings account. If you're thinking, wait, that can't possibly be right, I regret to inform you that your doubt is misplaced. This actually happened to real human beings who are now probably too rich to acknowledge your existence. Here's where Buffett really differentiates himself from your average billionaire with questionable hair. Berkshire Hathaway never paid its shareholders a dividend. While other companies were handing out quarterly allowances, Buffett kept all the money in the family business. Instead of giving you a fish, Buffett taught the fish to breed more fish, which then learned to breed superfish, which eventually took over the entire financial ocean. This is compounding on steroids. Completely legal, but unfairly effective. While dividend investors were cashing quarterly checks and feeling smug about their passive income, Berkshire shareholders were watching their shares transform from ugly ducklings into golden swans, if swans were worth over $500,000 each. During this 45-year period, the market experienced more dramatic crashes than a demolition derby driven by caffeinated toddlers. Black Monday, 1987, Berkshire yawned, the dot-com bubble, a flesh wound, the 2008 financial meltdown, a shopping spree, the 2020 pandemic crash. Just Tuesday, in Omaha. While everyday investors were panic selling their life savings, Buffett and Munger were deploying capital with the calm precision of brain surgeons, if brain surgeons operated, while eating peanut brittle and drinking cherry Coke. During the 2008 financial crisis, when the world seemed to be ending, Buffett wrote, "Buy American, I am." This wasn't luck or timing. It was the financial equivalent of having ice water in your veins, while everyone else mainlined espresso. Today, Berkshire Hathaway is less of a company and more of a financial solar system. It fully owns over 60 companies, everything from underwear to insurance, batteries to ice cream. Your entire day probably involves using products from at least 5 Berkshire companies before lunch. Berkshire is basically a mutual fund wrapped in a holding company disguised as a value investor's fantasy, the Russian nesting doll of capitalism. While Wall Street firms operate from glass towers with trading floors that look like NASA mission control having a seizure, Buffett runs his empire from an office in Omaha with fewer employees than your local Chipotle. Buffett's secret sauce isn't just what he buys, it's how he operates. He acquires companies and then does something revolutionary. He leaves them alone. No synergy consultants, no rebranding exercises, no corporate retreats where executives build towers out of spaghetti and marshmallows. So, what's the moral of this financial fairy tale? Besides making you want to build a time machine, specifically to go back to 1980. First, compound interest isn't just a mathematical concept, it's a lifestyle. Buffett isn't a billionaire because he's smarter than everyone else. He's a billionaire because he's been smart consistently for over 70 years, the financial equivalent of the tortoise racing against hares with ADHD. Second, boring makes money. Berkshire didn't invest in whatever the hot new thing was. They bought carpet companies and insurance businesses, the financial equivalent of eating your vegetables while everyone else was mainlining sugar. Third, the best time to plant a financial tree was 40 years ago. The second best time is today. The principles that turned $1,000 into a fortune still work. They just need time, which, unless you're Benjamin Button, only moves in one direction. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Berkshire Hathaway isn't just a company. It's the ultimate case study in financial patience, paying off more handsomely than a lottery ticket factory. The $1,000 that became $2.14 million wasn't magic or luck. It was math combined with mental fortitude. The kind of investing that doesn't make for exciting TikToks, but does make for exciting bank account balances. So, what's your takeaway? Maybe it's to find the next Berkshire. Good luck with that. Maybe it's to buy Berkshire now. Better late than never. Or maybe it's simply to adopt the Buffett mindset. Buy quality, think long term, ignore the noise, and let compound interest work its mathematical magic. If you learned something from this video, smash that like button harder than a 1980s investor who didn't buy Berkshire would smash their time machine. Subscribe for more financial wisdom that's hopefully less depressing for those of us who weren't investing during the Reagan administration. Remember, the best investment is always in your own financial education and occasionally in whatever Warren Buffett is buying. May your returns be high and your stress levels low.